I guess I should sit up, huh?
All right, welcome everybody. We are back for another installation of Financial Aid Atlas. Uh, we're going to be going over loans today, everybody's favorite topic. So we're going to be going over about borrowing, why you should borrow, how you can borrow. We're going to do a deeper dive into some terms related to this facet in the next episode. So it'll be a two-parter, but we are going to make sure that this is recorded as we always do. We're going to make sure that we have some time for Q&A at the end of this. So if you have any specific questions, we're going to make sure that we have some time to answer those with you later in the session. We are going to make sure that if you have any questions beyond what we go over tonight, you have our contact information so you can reach out individually. As always, I'm Zach Sawyer from the admissions side, joined by everybody's favorite financial aid director, Ryan French, who's going to take this opportunity to walk through this wonderful topic of student loans with you tonight. So without any further ado, I'm going to pass it off to Ryan.
Thank you, Zach, and welcome everybody. Thank you all for being here and for watching along with us. If this is your first time here, welcome. There's lots of content out there, prior to this episode. So take a look at the website under the admissions page, under a page called Panel Discussions. You can link to all of the previous webinar episodes. You can also go to our YouTube page under videos and under live, and you can see all of the content there as well, along with plenty of other fun content about the school. So check all that out. If you've been here before, welcome back. Thank you so much for being here with us. We are going to take a dive into student loans, and we split it into two episodes for a couple of reasons. One of them is just a lot of information, and I want to make sure we leave time for questions, and I didn't want to just jam a bunch of information down your throats and and then just send you on your way. So we're gonna split it out. We'll do an episode tonight, and then we will do an episode in 2 weeks now, and sort of split it out. So we're gonna talk tonight about why you might borrow loans, and then kind of talking about the budgeting behind loans and where to find loans. And then in the next episode, we're going to kind of go a little deeper into, interest rates and terms and comparing those things and kind of looking at the general timeline of borrowing. So if you have questions about those things, I'm happy to answer them, but just know that we're going to go a little deeper into that stuff in the next episode. And tonight, we're really going to talk about kind of a background on loans and then kind of where to find them and start doing your own research. And hopefully I can give you good information tonight. All right. So we're going to start with why borrowing matters. um, I will say right off the bat, you can see that 61% number there. Only 61, only. This is a national stat. 61% of bachelor's graduates, so students graduating out of higher ed with a bachelor's degree, 61% of them in the country borrow with some type of loan. A lot of those tend to be federal loans. Some of them are private. We're going to talk about all that stuff. Here at MMA, it's almost right in line with the national stat. It's slightly less. We're at 57% right now. If you went back and looked at last year's episode, it was even slightly less than that. So it fluctuates around. But so that's just to give you an idea. 61% of students are borrowing loans. Now, you may be walking in here thinking borrowing is not part of our plan. But I'm going to assume that if you're watching this episode, you've at least considered student loans. And so hopefully we can give you some information about that. Student loans are really important. They can be really, really helpful for a number of reasons. One of them, it's an investment in your future. Like as a student, education is an investment in yourself, in your future, in your career. And borrowing a loan is sometimes the way that you are able to make that investment. When you look at some of the statistics out there, they kind of show that students with that higher level of education tend to earn more over their lifetime, especially here at Maine Maritime Academy, with our return on investment being kind of on the higher end of the national averages. Georgetown did a study back in 2019 that that put Maine Maritime Academy in the top 10 for return on investment in the country. And I believe there have been recent ones. Money Magazine and U.S. News and World Report have provided similar, information about that, similar stats, sort of ranking Maine Maritime Academy with the degrees that we offer, the programs that students are participating in, and the careers that they're going into, really making a significant amount of income, which honestly makes borrowing a loan a little bit easier to swallow, if that makes sense. Um, so another reason loans matter is its access, right? So there's plenty of students out there who may not be able to go to college unless they borrow loans. And that's why so many students wind up borrowing loans so that they can pay for school and cover those expenses. And borrowing gives you that opportunity, usually regardless of your current financial situation. So they can be a really good and useful tool, opening doors to those academic programs that maybe you wouldn't have considered possible previously. It gives you some financial flexibility, and when I say flexibility, I mean rather than trying to pay the entire bill up front, potentially putting a significant financial burden right up front on your family, on yourself. You can spread it out, so it allows you to borrow a loan now, pay it back later, spread your education out over time, the cost of your education out over time, and pay for it gradually, with kind of deferred repayment options. So in a lot of cases, you don't have to make payments while you're enrolled in school, and that kind of gives you the opportunity to really focus on school and deal with the financials after. It also helps you build credit. So there are credit benefits to taking out a loan. If you're a student, you're graduating out of high school right now, you're getting ready to go to college, taking out a student loan can kind of set you up in a way that maybe some other students are not going to be, or other people your age are not going to be in a position to do. It's going to help you establish credit history, meaning you are claiming that you are declaring up as a borrower, at a younger age, so that when you do graduate and you start making payments on those loans, you start establishing this credit history of responsible borrowing and responsible repayment, so that when you go to get that car loan or you go to get that mortgage after you graduated because you want to buy a house, a lender is going to look at that credit history and say, "Oh, look, this kid, they got their student loans in school. They've been paying them back. This is somebody that we want to lend money to." So it can be really, really beneficial. There's also some financial responsibility associated with it. So if you are interested in borrowing loans, you're going to have to learn how to budget. You're going to have to learn about prioritizing those expenses, and those are things that are going to help you, make informed financial decisions moving forward as you build those skills. You're going to carry them with you after you graduate, and those can be really beneficial things. That other stat over there, the less than 2%, I mentioned, that's our default rate. And default rate means a student who has borrowed loans, they've graduated, if they're unable to make payments, sometimes those loans will go into default. The national average is about 7% right now. It fluctuates around. Here at Maine Maritime Academy, it's less than 2%. And a lot of that has to do with that return on investment that I was talking about. Some of it has to do with our our job placement rate, which has been 95% in 90 days, meaning the majority of our students are going right into the workforce after graduation. And in many cases, they are they have starting salaries many percentage points above the national average for those careers. And especially in some of our programs and limited license programs, and even some of our non-licensed programs, they are starting at higher levels than their peers coming out of other schools. So those are all contributing directly to that really low default rate, meaning students are in a position to pay their loans after they graduate, and usually pay them off easily and pay them off early, which is really important. So when we talk about loans, one of the questions that I get a lot, or the two main questions that I get a lot, are, how much do I need to borrow? If I'm going to borrow a loan, how much do I need to borrow? And how much can I borrow? And those are two very different questions. And I usually, when I'm talking to families and we're trying to budget and plan, we're looking at cost of attendance. And we talked about cost of attendance and financial need and all the things like that in a previous episode. So you can go back and check that out if you're interested. But very briefly, your cost of attendance it's a budget. It's kind of an estimate where we're generally really focused on where your state of residency, so how much you're paying in tuition, the program that you're in, any ads and extras on there, so we can nail down a really really good estimate. We're pretty good at that here in the financial aid office, but it is still an estimate, so it's a budget, and we sort of look at it and work with it as we go through and try and figure out what maybe your estimated payment, your estimated bill is going to look like when bills come out, during the summertime. But that total cost of attendance is that estimated total cost for 1 year of school. And so it includes a lot of things. It's got your direct costs and your indirect costs. If you look at that graphic right there, it's showing that it's got all the tuition and fees. It's got your food and housing. It's got maybe some of the additional costs related to the license if you're doing an limited or unlimited license program, regimental fees if you're participating in the regiment. But it's also going to include some indirect costs as well in that total cost of attendance. And those are things that the school does not bill you for. So when you're looking at your cost of attendance, it is always going to be higher than what the school is actually charging you in a year. But it's a really great tool, especially when you're trying to compare schools or you're trying to figure out your budget. It's important to think about those indirect costs, those things that books and supplies and transportation and personal expenses, things that maybe, obviously the school isn't going to bill you for your personal expenses. However, it's important to remember that, hey, yeah, I'm going to school and I've got a meal plan and I've got a housing plan. So I don't have to worry about those things, but maybe I do need to buy a bus ticket home for Christmas, or I do need to go out and buy a couple books for one of my classes, or whatever they may be. Those are expenses, and so when we then transfer that into the conversation about loans, it comes into play because that is what gives students the ability to borrow and potentially cover some of those indirect expenses. So when we say how much can I borrow, we're talking about the maximum amount of money that you can take out in a loan. And this is primarily for private loans, although we will talk about a federal loan program that allows you to do this as well. But that maximum loan amount is your total cost of attendance. So all of your direct costs, all of your indirect costs, and you subtract out any financial aid, your estimated financial aid that you've already received or you're anticipating to receive. And so that estimated financial aid is including federal, institutional, private, scholarships and grants and loans and anything else that's already on there. You subtract that from your cost of attendance, and that's the maximum loan amount that you can receive. The flip side of that is, what's the least amount of money that I have to borrow to cover the bill? And that is a slightly different math problem because we're focused more so on just the direct costs. So like I said, we're trying to pay the bill. So we're only going to look at those billable costs, those direct costs, the tuition, the fees, the food, housing, license fees, whatever. And then we're going to take out any financial aid that we've already accounted for, grants, scholarships, maybe the federal loans that were offered when we completed the FAFSA, what have you. And then you can also subtract out any payments that you're planning to make to the school if you've got a savings account, or you have a 529, like a college savings plan, or you want to set up a payment plan or something. Those are all things that can be included in that math when we start looking at what is the least amount of money I could possibly need to borrow to cover the bill. So I want to give you a couple examples. I put together like a student in my mind whose total cost of attendance, everything included, all of their indirect costs, all of their direct costs, things that we're going to bill for, the things that, maybe a plane ticket, books and supplies and things like that. Their total cost for the year is $50,000. And let's say they've got some grants, they've got some scholarships, maybe they're planning to take out their federal loans, and altogether that estimated financial aid is $20,000, right? So that student, that 50,000 minus 20,000, their potential loan amount that they could get is $30,000. Now that's way more than they may need, but that is the maximum loan amount that they could get based on all of that math. Um, so then if we take that same student and we say, okay, let's strip out all of the indirect costs. So we know maybe we've got those covered, we've planned for those, we just want to focus on what's going to be on the bill. Great. That number isn't 50,000. Let's say it's 40,000. And I'm using some estimates here, but pretty good rough math there. Direct cost of attendance is only $40,000. Okay. They've still got the same aid, that $20,000. And maybe they've decided we're going to set up a 10-month payment plan of $5,000. We're going to pay $500 a month while I'm enrolled because we have this money maybe in a 529, or we've just been planning to make these payments all along. And maybe we've got $5,000 from grandma too. She wants to kick in for freshman year. That's a total of $10,000 in payments. So when you do that math, the $40,000 direct cost, the $20,000 of aid, and that $10,000 in payments to the school, that means that in order to cover the bill for the year, we might only need a loan for $10,000. So when you look at that student, their range is somewhere between $10,000 and $30,000 is maybe what we're looking at for a loan. And when we sit down, when you call me up on the phone or you call someone else in my office and we start having this conversation and talking about budgeting and planning out how are we going to cover the year, those are kind of the numbers that we're going to be looking at. We're going to be looking in between that minimum and maximum loan amount and say, okay, what is reasonable? What makes sense? Maybe we really want to pay $5,000 over those 10 months. We want to set up that payment plan, but we're not really sure about it. We want ourselves to have a little bit more financial flexibility. So we say, okay, maybe we don't do that. And we increase the loan or we borrow a little bit more just so that we have that buffer. Additionally, when you start like really having that budgeting conversation, you may also think, okay, yes, I really only need $10,000 to cover the bill, but there may be a plain plate. There may be, some personal expenses that we want to cover. There may be some things on top of what we can afford and on top of what scholarships that we've gotten that we want to plan to borrow for. And so you might go out and apply for a loan that's greater than what you need. And then, throughout the year, there are going to be opportunities for us to make adjustments. So you can go out and apply for a $20,000 loan, knowing that you only need 10. And if we get to the beginning of the semester and you say, you know what, I don't actually need that extra 10,000, that's fine. We can make that change at that point. I'm going to go into some of the strategies about that in our next episode, but just putting it in your brain, there's a lot of flexibility with loans. It gives you a lot of financial flexibility and freedom. So it can be a really good tool. It is also very important to only borrow what you need. So one of the things that I think may be on many people's mind thinking about loans is all the stories that you hear about the rampant student loan debt in the country. And those are all true things. There is a problem with student loan debt here in the United States. And plenty of students are in a significant amount of debt. And I just want to promise you that our goal here at Maine Maritime Academy and especially here in my office is to try and find as much free money as possible. Like that's my first and primary goal. But loans can be a really good tool. So I want to make sure that you guys know, you don't necessarily have to be scared of student loans. They can be a really good and helpful tool. And that's kind of what we're here to help you navigate and plan and budget and figure out. So now that we've talked about all of that fun stuff, let's talk about the types of student loans that are out there. Three major categories. I've mentioned these before. Some of this is going to be a little bit review, but I'm going to try and go into a little bit more detail on it as well. Three major categories are federal loans, private loans, and institutional loans. The two big ones really are the federal and private. Institutional, not all schools offer institutional loans. We do, but it's a very limited program. But the federal loans are offered by the federal government to students and occasionally to parents as well. And they typically are really good programs. They have some benefits that other loan programs do not, and they also have some protections because it is a federally backed loan program. Private lenders are offered by a variety of sources, banks, credit unions, and mostly private lenders out there. And they have a wide range of interest rates. They have a wide range of credit terms and credit requirements when you go to apply for those loans. And we'll go into more of that in a little bit more detail tonight and in a lot more detail in the next episode. And then we do have a limited amount of funds institutionally as well. We kind of hold those back for students who maybe have had some trouble with other loan programs. Maybe they've gone out to find a private loan and have been denied, or they've been offered a really bad interest rate. We do have institutional loans available. I'll go into a little bit more information about that in a second. So, starting with the biggest category, the Federal Direct Student Loan Program. The FAFSA is your application. As a student, you complete the FAFSA and you will be offered loans, almost guaranteed. If you're eligible for any federal aid, you will be eligible for federal student loans. As a first year dependent undergraduate student, you're going to get offered $5,500 in federal loans. Depending on the calculations that are done with your FAFSA information, depending on your family financial situation, a portion of those loans may be offered as what are called subsidized federal direct student loans. So subsidized loans are available to undergrad students who have calculated financial need, meaning the math that comes out at the end of the FAFSA has indicated that your family may qualify for some need-based aid. Like I said, we did sort of a whole episode on some of the need calculations and stuff previously, so feel free to check out that on our website or on the YouTube page. But the key point with those subsidized loans is that the government is paying your interest. So from the student's perspective, it's interest-free, which is usually how they're presented. They are interest-free loans. It doesn't matter, but just a fun little tidbit of information. They're not actually interest-free. The government is just paying your interest while you're in school. That's why they're called subsidized loans. So every student who is eligible for federal aid is going to get offered a portion of unsubsidized loans. Depending on that need calculation, the loan that you get offered might be entirely unsubsidized. And that means that it is accruing interest while you're enrolled in school. For both of those loan programs, subsidized and unsubsidized, you're not required to make any payments while you're enrolled in school. And that's true for a lot of student loan programs, even the private ones. You don't have to make any payments while you're in school if you don't want to. For the federal loan program, there's no benefit to making payments necessarily while you're enrolled in school, except that you're not carrying these balances over time. So if you choose to make payments, it can be beneficial after you graduate. Whereas with private student loans, maybe they do offer better rates or terms if you commit to making payments while you're enrolled in school. But we'll talk about that in the next episode as well. I do want to mention there is also the Parent Plus loan program, which is a federally backed loan program. It's offered only to parents of dependent undergraduate students. There is also a Plus loan program for grad students, but we're not really talking about grad students tonight. So for that Plus loan program, the parent is the borrower, and it's on behalf of their dependent undergraduate student, meaning the parent has to log in to studentaid.gov. The parent has to fill out a loan application. The parent does get a credit check, and if they pass that credit check, which the credit requirements are pretty, I won't say they're like simple or super easy. I would say for the most part, parents are going to qualify for the Plus loan program because the credit requirements are lower than out in the private loan world. It does happen that parents do get denied for the parent loan program, and that can actually be kind of a tool that we use if you happen to be in a family financial situation where you think that it's unlikely you will qualify for a parent loan, then we may encourage you to apply anyway, because your student may be eligible for more of the federal student loans in that case. Those are really rare circumstances, but put that in the back of your brain. If that applies to you, you think we should have a conversation about it and kind of talk that through. But the key with the Parent Plus loan program is that it is designed to cover up to that cost of attendance. So minus any of that aid, it is a max loan program. You can borrow as little as you want, but it tends to be one of those programs that's because it's so easy to apply, and because it's easy to lose track of some of those the federal loan services that are managing the loan. It's easy to borrow more than you need with that program. So, it's something that we try and use with caution, and then it doesn't always work for everybody. So when we talked about some of those credit benefits for students, this Plus Loan program doesn't have any of those credit benefits for the student because the parent is the primary borrower on the loan. So I'm throwing that out there. It's a program. It works for some people. It doesn't work for everybody. If you want more information about it, I'm happy to talk to you about it. And it does wind up being a pretty good backup option. But I encourage a lot of families to just sort of check out what's out there in the private loan world before you default to the Parent Plus loan program. Moving on to private student loans. We use a third party called Elmselect. You can see the website there, www.elmselect.com. They list out a bunch of private lenders that we've sort of seen student success with. So it's a pretty good website where you can compare. You can see the list of the lenders there on the screen. There's a bunch of lenders out there. That's by no means is that an exhaustive list of student lenders out there. Those just happen to be the ones that most of our students are utilizing. And Elmselect gives you the opportunity to compare and contrast some of those rates and terms, or at least the ranges of rates and terms, before you commit to filling out a loan application. So you can kind of do a little homework and get a feel for what's out there. They are offered by private banks and credit unions as well. So if you have an existing family relationship with a local bank or credit union, it is worth checking with them to see if they offer a student loan program. Many of those student loan programs are managed by one of these big name private lenders. But sometimes with a credit union or local bank, you may get a preferred rate if you've got an existing relationship with that bank. So it's worth checking and seeing what's out there. It's important to remember these loans, they're not the same. They're not backed by a federal loan program, meaning they're not backed by the federal government, which means, you are going to have to, apply. They're going to do a credit check on the student. You're probably going to need a cosigner. Most students who are graduating out of high school, if they've got credit history, they don't have much. Many students don't have any credit history at all. So you need to have taken out a credit card or co-signed on a car loan or something like that to have any kind of credit history. So it's possible that you may not have any credit history at all. And lenders don't tend to let people without any credit history borrow loans on their own. So a lot of these private lenders out there are going to require a cosigner, or a parent, grandparent, family friend, something like that, to put their name on the loan to sort of, improve the credit rating basically of the loan for the lender. So if you're in a position where you don't think you can get anybody to co-sign on a loan with you, definitely reach out. Let's have that conversation. If you are a parent who, isn't in a position to add anything to their credit history, or, you've recently declared bankruptcy, or that you've got a really bad credit rate, let's have that conversation. We can definitely talk that through and see what might make more sense. I do want to point out one lender in particular, which we talked about in the last episode, is from the Finance Authority of Maine. They run the Maine Loan Program. That's open to any student that's attending Maine Maritime Academy. You don't have to be from the state of Maine. And that program, because it's it's managed by the state. It's partially, or it's managed by a state organization. They tend to fix the rates at reasonable levels. My first year here, the rates were crazy low. It was a really, really good loan program, and I encouraged a lot of people to jump on and apply for that loan. This last year it was more middle of the road average loan rate, but it is a really good program. They're a really good organization. They're a great resource beyond loans. We talked about scholarships, and they manage some of the grant programs and tuition waiver programs that are out there. If you want more information about that, we talked about it in the previous episode. So definitely check them out. They can be a really good loan to borrow. One thing that's important is they're going to be one of those lenders that's going to require a cosigner. Even if you are a student who has some credit history, they will probably still require you to get a cosigner in order to get approved for the loan. But it is a really good program. And so if you're in the financial position, you have a cosigner's got a decent credit history or credit score, then it'd be a pretty good loan to check out and definitely compare it to maybe some rates that you get elsewhere. Excuse me. So these private loans, much like that plus loan program that we were talking about and some of that math that we were talking about before, these private loans are designed to cover all of your costs. So when we talked about that minimum loan, maximum loan conversation, those math problems that we did earlier, these private loans are the ones we're really talking about. So you've decided, yeah, maybe I am going to take out those federal loans. You've got your scholarships. You've got maybe some, a grant that you've received or private scholarships from, private organizations that you've gotten scholarships from. You've made your payments. You've got your 529 plan. You've put some savings towards your bill, and now we're getting to the point where, okay, but we've got a little bit left over. We've got to cover this last amount. Where are we going to go? This is where we're going to go. We're going to start looking at these private lenders and doing our shopping, kind of looking around at applications out there, getting a feel for what kind of rates and terms we might get. And that's a really good time to come talk to us and have that budgeting conversation together, look through everything, really come up with a solid game plan for applying and nailing down a number and all that stuff. And we're going to talk about some of that stuff in the next episode. Some of the budgeting stuff, some of the that kind of loan timeline, and really dig into some more of that information. But if you don't want to wait, give us a call. Reach out to the financial aid office. That's what we're here for. We've started getting FAFSA information coming in, so we can really have better conversations about what aid you may receive or not receive, and we're getting a better picture for students, like what it's going to look like. So please feel free to reach out, and we can start having that conversation now. I do want to briefly also reiterate our institutional loan program. I say there over the side, what if I can't get a loan? I don't have a cosigner, or I have a cosigner, but we applied and we get denied, or I have a cosigner and we applied and they offered us a 15% interest rate, which is crazy. If you get offered a 15% interest rate, please come and talk to me. Those students, I would encourage to reach out and inquire about our institutional loan program, because that's kind of what we save that money for. We are limited. I'm only allowed to lend $10,000 per student per year. So when you think about some of the students who have higher expenses, some of the students who maybe don't have a ton of scholarships walking in the door, $10,000 may not cover everything, but it can start us in the right direction, and it can be a good fill-in at the end for sure. It is a fixed interest program. I'll talk in more detail about it in the next episode. But importantly, our loan program is fully deferred, just like those subsidized loans. We don't charge you any interest while you're enrolled in school, and you're not required to make any payments if you don't want to while you're enrolled in school, which is why it tends to be like, it's a slightly better program, but we are very limited on how much money we have and what we can lend to students. So, all right, that's kind of all you need to know. There may be more information out there. I would definitely encourage you to do your research online, reach out to us if you have questions. But there are additional resources available. We have some of this information. We link out to Elm Select on our website. There's some information in there about cost of attendance and stuff. If you have questions, please do not hesitate to reach out. I'm here. Angela is here. I left Jeff's name off of this list, but Jeff Walls, our newest employee here in the financial aid office, he is here as well. You may have talked to him. We also have Zach, our wonderful MC. Zach is here as well in admissions. You may have talked to him as well. Assistant Director of Admissions, wealth of knowledge over there. Also worked with me in financial aid, so has some of those chops too. But he's outside of the financial aid world these days. So maybe don't send all of your financial aid questions to Zach. That's what I'm here for. And then if you have questions about sort of what the bills look like, what that might start to look like, you can reach out to our billing office. Diane and Casey up there are really great resources. And yeah, feel free to ask some questions in the chat. Hopefully we've had some questions. And usually this is the time that Zach jumps in and starts asking the questions to me so that I can answer them live on air. I do want to mention briefly our next episode on April 24th, so 2 weeks from today. We're going to do that deeper dive into student loans, talking about rates and terms, and then we're going to dive into sort of like the timeline for loans as well in that episode. So ask your questions. Let's go.
Yeah, so great talk, Ryan. Thanks, buddy. And yes, I am still toes deep in this financial aid world, but if you have individual questions, I would highly suggest reaching out to Ryan and his team specifically. If you want the 10,000 foot overview, I'm happy to help out with that on the financial aid side. But as it gets a little bit more granular, I have a harder time answering those questions as I no longer have access to some of the financial aid resources that Ryan and his team do. But if you have questions about majors, let me know. Town of Castine, I'm the guy. But financial aid, really specific questions about your individual situations, what to fill out and how to fill it out, and what are we receiving, what should we be looking for. Those are great questions for Jeff and Ryan and Angela. Ryan, we did have one question that came in through the chat, and I want to put it out there really quickly, and it had to do with the FAFSA update. And we didn't, for the first time, we haven't actually done a quick flash FAFSA update at the beginning of this episode, which we've kind of been doing previously. But Nadine asked, we haven't heard back yet. How is all of this related to the FAFSA piece? We checked, it's been submitted. How do loans and FAFSA all kind of filter in? And I know that that's kind of a multi-part answer for you.
Yeah, so how is it related to the FAFSA crisis? That's what I'm trying to figure out how to answer. I mean, I would say if your question is you haven't heard back from us yet, it's possible that is related to the FAFSA crisis. There's a couple things going on right now, which is obviously there's the major delay. Students who have submitted their FAFSAs already and they have been processed, we should have received them by now. And we have been going through and processing those as quickly as we can. There is a small percentage of students who submitted their FAFSA, we received it, we processed it, but the data is potentially still in question because the federal government did not potentially calculate everything correctly when they sent us the data. So we have a list of students who potentially have been impacted by that, who we will have to receive new information from the feds on. You're not required to do anything if you're in that position. It's all going to happen behind the scenes, but just be aware there are still a lot of things holding up the process. But I would say if you've submitted your FAFSA, everything's in. You can check out the financial aid portal. That's myfinaid.mma.edu. You can see right on your student's homepage under, I believe it's under documents, if it says that we have received the 24-25 FAFSA, then just hold tight because we're trying to work through those as quickly as we can. If it says it has not been received, definitely reach out because it might be an issue. Sometimes those things kind of get lost in translation and the information doesn't get put on file correctly. So check that out. Let me know. Reach out if you have other questions, and I'm sure we'll be in touch. Related to like loans in general, and the FAFSA, there really isn't much that's changing with this new FAFSA other than potential eligibility for students. So I would suspect that we're going to have more students who are eligible for those subsidized loans that I talked about because of those new calculations. And then we get some of the information that determines what kind of aid you're going to receive from the FAFSA, meaning, a student who completes the FAFSA is potentially going to have to borrow less privately, and may even have to borrow less federally if they've received federal grants, they've received need-based scholarships. So they are all tied in together. If that was the question, but yeah, if you haven't heard back and you're worried about it, please feel free to reach out. I'm here, Angela, Jeff, all three of us can take a look and see what's going on.
The only other thing that I was thinking, Ryan, is talking about how it does calculate towards total EFA. So if you're looking at applying for additional scholarships or loans, it would take away from the total amount that you're eligible for once you receive FAFSA loans, theoretically.
Sure. Yeah,
Okay.
that's
And,
true.
and Nadine, if you're still in the chat, please let us know if we didn't quite answer the question. We'll be happy to reapproach and give you more clarity if we haven't solidified that up for you yet. And anybody else who's listening right now, go ahead and throw something in there. Ron, I did have a question that was submitted previously. Plus loans. Can I use a plus loan if I don't use my direct loan? So if my student doesn't take out any of their direct loans in their own name, am I still able to apply as a parent for a plus loan to cover the total amount without accessing the direct loan programs for my student?
Yeah, that is a really great question. Um, you're certainly allowed to. I don't know that I would necessarily encourage it. With those loan programs, they are both federally backed programs, so they're good programs, but the student loan tends to have a lower interest rate. We'll talk about that a little bit more in the next episode too, like those differences between rates. The plus loan rate has a higher interest rate, and there's no credit benefits to the student because the student is not the borrower. So if you're going to be borrowing, if you're planning to borrow and you're focused on that plus loan program, fine, let's talk it through. But I think you should be borrowing the student loans first because it will be a better program, I think, in almost all cases. So you certainly have that option, and I definitely have students who, maybe parents have like crazy great credit, or they've got a really good relationship with their private bank, and they've received a loan rate at a really, really, really low rate. Um, they don't borrow the federal loans at all. So that's also an option. You can choose to do that, and that's sort of just one of those things that we would have that further conversation about as we have one of those budgeting calls and sort of sitting down and going over all the details and figure out what makes the most sense. But I would say in like 90%, more than 90% of cases, like I said at the top, if you're going to be borrowing at all, if that's part of the plan over the next 4 to 5 years, that you may or may not, you might borrow a loan in the next 4 or 5 years, you should probably capitalize on those federal direct student loans first as they're offered each year because they do wind up being one of the best and most favorable loan options out there.
And beyond that, my 2 cents on that is it's good to have your kid have some skin in the game financially. Those loans are due back to the Fed the second the student disenrolls, more or less, if it's before graduation. So if they leave early for any reason, they owe that money back, and it's in their name, so they take onus of it. So for me, I always thought that having a little bit of danger associated with leaving school was worthwhile for a lot of kids. Helps them focus on getting to the finish line because they have a little bit of a grace period if they make it all the way to graduation and start making repayments, and they have the degree to boot, so they'll be able to their earning potential kind of jumps up if they get there all the way. Nadine did say that her son reached out, but hasn't. That his FAFSA has yet to be received. So according to what Ryan was saying, he was potentially part of that population that just had a setback, and we should be receiving their information relatively soon. But I would suggest, Nadine, potentially you call Ryan's office tomorrow, maybe have a conversation. Ryan?
Yeah, I think that'd be a great idea. I was trying to pull, Nadine, I was trying to pull your student up real quick to take a look. Um, it's, I think it's based on what he said. It sounds like I'll throw this out there for everybody. Um, right now, we're in this weird holding pattern where if a student hasn't put everything on the FAFSA that they intended to, meaning they've missed a spot or they didn't sign it or they didn't list Maine Maritime Academy on their FAFSA when they submitted it, there's still no way for them to go in and make those corrections. So if that's the case, we have to wait, unfortunately, uh, until the feds kind of catch up and give students that ability in at studentaid.gov to go in and access their FAFSA and make those corrections. If that's not the case, um, we'll just have to double check and see, what's going on. So, yeah, Nadine, please feel free to reach out, and I will take a look for your students' information in my inbox, and we'll take a look in the financial aid inbox, and we'll get back in touch with you tomorrow. I promise.
Awesome. Matthew McGee asks, do you have any specific advice for independent? Sorry?
You say independent students?
Yeah, independent students in terms of
Oh,
loans.
yeah, sure. So independent students, great. So this is kind of a weird little, a lot of times when I'm talking to families, I'm talking to families of dependent students walking in the door out of high school. It's a very specific conversation. I'm very used to having it. So I did kind of tailor this webinar episode to those. So I apologize, Matthew, that I didn't give more information on independent students. Independent students, when they show up, they should also complete their FAFSA. 100% do your FAFSA. One of the reasons you should do that is as an independent student, we don't have to take into account any parental financial information. So unless you're making, you have been consistently making a lot of money, like you're in a really, really good financial position coming to school, you will probably be eligible for some additional programs. And at the very least, as an independent student, you are eligible to borrow more direct student loans um, than your dependent student is. It depends on what year of school you're in, how much you're allowed to borrow. We can go over that. I'm going to go over a little bit more of that in the next episode, but you are allowed to borrow more federally. As an independent student, it may be necessary for you to start looking at student loans out there. There's really no difference in how that's all structured. It's still a student loan. You're still borrowing it as the primary borrower. You're still allowed to get a cosigner, even if you are a independent student. If you have someone that can cosign on the loan, I highly encourage it. But that loan process and the research on those private loans is going to be the same as for a your typical dependent student borrower as well. But like I said, the federal loan program specifically gives independent students slightly more access to those federal student loan programs that the than your dependent students get.
Awesome. If anybody else has any additional questions, go ahead and throw them in now. I'll wait just a couple minutes. But remember, next time we come back together, we're going to continue looking at loan programs. We're going to go into more specific terms and rates and what you should be looking for and how to kind of evaluate different programs as we go forward. So there will be a deeper dive into this topic at the next date, which will be in 2 weeks because we had our 1 week delay after last week's storm. I'm glad that we did that. We did end up losing power here in Castine, so it might have been an abrupt ending to that that program if we had gone on as necessary. And as you guys might have noticed, I'm in a new home here. I have been relocated onto a desktop computer in our sound booth for our auditorium with a much better connection. So hopefully you have seen that as this content has been going out on YouTube. There's been a better capture here of audio and video for you guys. So I'm looking forward to having this set up going forward and making sure that we have good content going out there of high quality as well. Any other questions? No? Ryan, do you have anything else you would like to put out there?
Really quick, Nadine, if you're still on here, we got your students' FAFSA. I just checked while Zach was talking. So we have the FAFSA. It came in. It actually just came in today, earlier this afternoon. So, you know, they'll get something from us probably tomorrow or Friday. I would guess was when we'll start doing the processing on that.
Good news all around.
Yeah.
Love to hear it. All right, excellent. So nobody else has thrown anything in there. Sounds like that's kind of it for today. Do remember to log in for this next time. We're going to continue this conversation. I've had a great night, Ryan. Hopefully you have too. Everybody who's joined
I always
us,
have fun doing
hope
these,
that
Zach.
you guys have enjoyed this. Again, it's because people have these questions and because you tune in each week that we do this, that we continue to carry on with this platform. So we hope that this is valuable to you, and we will continue to put out content if you find it of value. From me, thank you guys for joining us. I look forward to seeing you again in 2 weeks' time, April 24th, Wednesday, 7 p.m., same place, same time. So for me, thank you so much. We'll see you soon.
Yeah. Thank you all so much for being here. Thank you so much, Zach, for being our MC and data man and man behind the scenes. We really appreciate it. I really appreciate it. I feel like this would not go as smoothly if it was just me here. So I really appreciate that Zach is here. But really, really thank you all for joining us. Thank you for asking questions. Thank you, Nadine, for putting your student's name right in front of my face so I could double check on that for you. That's always really helpful. I really appreciate everybody who participates in these and all of the great questions and all of the great feedback. Thank you so much for being a part of it, and hopefully we'll talk soon.
All right. Thank you all. Have a great night.
Good night.